But I suspect that central banks are now starting to feel that they're in competition with each other to get the gold. Because we all know that there are worries about holding dollars, for example, due to the weaponization of the dollar, due to the fact there's not been any action to rein in the US debt. The government debt is getting bigger and bigger. It's growing by 6% a year. It's probably going to be growing by 7% this year. We might go into a new system at some point. There might be a series of steps. I've got several which I see as possibilities. But whatever happens, I can say that, and people are realizing this, gold is what can get you to the other side of whatever's coming.
You can feel it. Gold and silver aren't just rising, they're erupting. These markets may be tiny compared to stocks, but that's exactly what gives them their explosive power. It doesn't take a tidal wave of capital to move the needle. Just a modest rush of new money can send prices flying, and that's what's happening right now. Clive Thompson points out that silver's recent surge is a perfect example. It broke through $51, then $52, and nearly hit $53, all within a day, jumping more than 3%. For a metal that usually trades in quiet, measured moves, that's massive. But when you look at what's happening across the globe, the momentum adds up. Geopolitical pressure is building on every front, from rising U.S. China trade friction to growing global instability. In uncertain times, investors reach for hard assets, and silver and gold are still the go-to choices. Add in expectations of Federal Reserve rate cuts, and the case for owning non-yielding assets becomes even stronger. When cash and bonds barely offer returns, people start looking for something that actually holds value. And then there's the U.S. debt problem. With total debt pushing $37 trillion and interest costs swallowing nearly 20% of all tax revenue, the math simply doesn't work. Within a few years, that number could hit 25%. Thompson's takeaway is blunt. This isn't just a gold and silver rally, it's a symptom of a much deeper imbalance in the global financial system, one that investors are starting to hedge against. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
Now, gold and silver market is a much smaller market than the stock market, so it doesn't take a lot of money to move the gold and silver prices. So the gold and silver prices continued the rally they've been having literally all year. They continued to rise higher. So on Friday, on Tuesday, Monday, that's yesterday, spot gold surged through $4,100 an ounce. It's the highest price ever. It was up 2.21% on the day. Now, gold doesn't usually move that much. It's there's a lot of liquidity in gold. It moves up 0.25% or down 0.25% on a good day. So a 2% move is, as gold stands, it's a huge move. So up 2.2% on the day yesterday at 4,100, and I can tell you that as we speak now, gold is continuing to surge. It's 4,100, and guess what? $45. Another 40-something dollars up. By the time you see this video, in maybe an hour or so after I've made it, could be God knows where it'll be. But bear in mind the warning which is coming. So, silver was an even more amazing metal, but it's not the most amazing metal I'm going to get to yet. Silver surged above $51 and then above $52. For all I know, it might be above $53 now. We'll have a look at that in a second or two. So, silver was up 3.1% on the day. Another absolutely amazing move for a precious metal which shouldn't be moving all that much. And so where is the silver price now? Let's just have a quick look at that. $52.95. So it's gone through $51, $52, and it's on the cusp of going through $53. It wouldn't surprise me by the time you switch this video on that it's above 53. We don't know. We've got the US and China trade tensions going on. We've got geopolitical uncertainty everywhere. Geopolitical uncertainty is when people are worried about wars or other bad things which happen in politics. We've got the expectations of the Federal Reserve interest rate cuts. What that means is interest rates might be, well, they will be reduced, and if they're lower, then the cost of holding gold is less. Because if the interest rates are high, you can put your money on deposit and earn interest. And if you're earning 5% interest, you might say, why would I buy gold? It has no yield. But if interest rates are 2%, well, I can give up 2% for the possibility of making a gain in gold. So lower interest rates are generally perceived as good for non-interest bearing assets like gold or silver, or Bitcoin for that matter. And the other, perhaps the most fundamental reason why gold and silver, especially gold, is rising, is the robust central bank buying. So the central banks of major countries around the world, like Poland, like China, not all of them, but some of them, are buying gold. Now, it's not, up until now, it's not been a huge rush, but bear in mind that the numbers we get are very, very heavily lagged. So we're only just now seeing the figures for July or August, in some cases only up to June. So we don't actually know what they're doing this month, but I suspect that central banks are now starting to feel that they're in competition with each other to get the gold. Because we all know that there are worries about holding dollars, for example, due to the weaponization of the dollar, due to the fact there's not been any action to rein in the US debt. The government debt is getting bigger and bigger. It's growing by 6% a year. It's probably going to be growing by 7% this year. We're at 37 trillion of debt in the United States, and that should grow by 2 trillion next year. And the interest element, the interest that the government's paying on that debt, is getting larger and larger and faster. So just to illustrate that, a couple of years ago, the US was paying about 8% of its tax receipts in interest. Now, because interest rates on the maturing debt are higher, and also because the debt itself is higher, the interest cost is getting on for 18% of its tax receipts. And according to the Congressional Budget Office, if you crunch their numbers and look forward as to what they're projecting, in a few years it'll be 22% of their interest. So we're talking about interest costs being literally a quarter of everything the government gets in taxes, and that figure probably is set to continue going higher ad infinitum unless something is done. And that will be the subject of another video about what can be done and what will be done. But what I can tell you is that we might go into a new system at some point. There might be a series of steps. I've got several which I see as possibilities. But whatever happens, I can say that, and people are realizing this, gold is what can get you to the other side of whatever's coming.
Clive Thompson points out that while gold and silver are shattering records, the charts are flashing a quiet warning. Both metals have entered overbought territory. Gold's RSI is hovering around 80, silver's around 83. In simple terms, that means the rally has stretched too far, too fast. When markets hit those levels, it usually signals that most of the buying power has already been used up. Traders who caught the early move might soon start taking profits, which can lead to a short-term pullback. But Thompson makes it clear, overbought doesn't automatically mean a crash is around the corner. In strong bull markets, momentum can keep prices elevated far longer than most expect. What this really suggests is not panic, but patience. A correction is possible, maybe even healthy, as markets cool off before the next leg higher. For long-term investors, though, these short-term dips are just noise. Whether gold is at $4,000 or $4,500 isn't the real story. The bigger picture is that physical gold and silver are still the ultimate hedge against rising global debt, devalued currencies, and mounting financial risk. In a world built on credit and confidence, holding something tangible remains the most reliable form of protection. Let's get back to the interview.
The warning is this: the technical indicators for gold and silver are flashing red. The RSI, that's called the relative strength indicator, are at 80 for gold and 83 for silver. These numbers are both numbers which show that gold and silver are seriously overbought or in overbought territory.
What's in overbought mean?
It means that too many people have bought it in a rush, and some of them will change their mind next week and say, oh, maybe I made a mistake and sell what they bought, so the price goes down. But perhaps I should stress that overbought conditions can last for a very long time, and without the price going down, overbought conditions can become or will become normalized. But overbought conditions don't say for sure that the price won't continue surging ahead. It can surge ahead for a long time. But the warning is this: when we have a crash in a commodity, in a stock market or anything, it usually comes from a situation when it has been overbought. But overbought doesn't mean to say it's going to crash, but a crash usually does come from overbought. So it's like not a guarantee that it goes down. It could continue surging higher and higher. It's just that if a crash is coming, people say, "Told you so," it was overbought. So they always say after the event, anyone could see it was coming, it was way too expensive. Having said that, if you're in it for the long term and you're not planning to sell anytime soon, does it really matter whether you pay $100 more or $100 less or $500 more or $500 less? Because I think that at some point you'll be needing that gold and the silver to get you across the line from what's going to happen, which basically will mean that other investments you'll probably, to the extent you own other things, you'll probably suffer quite significantly. I did say that gold and silver weren't the best performers, so let's talk about the better performers, and it gets better still in a minute. So platinum and palladium were not left out in the precious metals rally yesterday. Yesterday, platinum rose 3.9% to $1,648, and palladium rose 5.2%, that's a lot, to $1,478. But it gets better. Now, this is not a precious metal, but one thing which did rise in the commodity sector was copper. Copper surged 6.02% on the day. It's up 9.3% on the month, which isn't quite as much as other things, and 16.66% year to date. So copper is severely lagging all the other precious metals on the year to date. But yesterday's move, there was a bit of a surge. And why was the surge in copper happening? Well, the answer is simply strong Chinese demand. I can tell you that across China they're building new motorways, they're building new railway lines. The demand for copper is huge coming out of China. And of course, we've got in the Western world huge demand coming from all these data centers, which they basically need a lot of copper to get well, you've got a lot of power going into the data centers. It's like powering an entire city, some of these things. So yeah, that takes a lot of copper wiring. So the demand for copper is not about to go down, and maybe copper will be the new gold. We will see, but don't try and buy the physical bars. They are very heavy. Interest rates, the markets are currently pricing in a 97% probability of a 25 basis point cut by the Federal Reserve on October 29th. Assuming that cut does come, it will take the interest rates in the United States down to a range of 3.75% to 4%. And the probability of such a cut happening by the year end is now priced in by the market at 100%. There hasn't been much change in US yields, which have been drifting very slightly lower on the back of these interest rate cut expectations, but it's not enough to talk about. It's almost imperceptible. As far as Europe is concerned, the European Central Bank, the ECB, is not expected to cut its interest rates. It has basically said that it believes that its current policy is robust enough to keep a steady hand and to manage shocks. We'll see.
What's unfolding in the precious metals market right now feels like more than a price rally. It's a shift in psychology. Gold and silver aren't just responding to rate expectations or inflation data anymore. They're reacting to something deeper, something structural. The global economy is drowning in debt, central banks are cornered between inflation and stagnation, and confidence in fiat currencies is quietly fraying. In that kind of landscape, tangible assets start to speak louder than policy statements. The explosive moves we're seeing aren't random bursts of enthusiasm. They're a signal that capital is searching for safety outside the financial system itself. Sure, momentum traders might take profits and algorithms might trigger a short-term pullback, but that's just surface noise. Beneath it, the foundations are shifting. The sheer scale of global leverage means there's no easy way out without debasement, and markets know it. Every dip in gold and silver is becoming an opportunity, not a warning. The deeper story isn't about how high these metals go this month. It's about what their rise says about a system that's losing credibility, one interest payment at a time. If gold and silver are the early indicators, we might be watching the first visible cracks in the world's monetary architecture forming in real time. So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.